Good afternoon, everyone, and welcome to Unlock the Stock with TWK Investments. Unlock the Stock is specifically formulated for retail investors to gain access to corporate management and get to know them and their companies better. This event is sponsored by A2X, a stock exchange that plays a vital role in the progression of South Africa's financial markets. A2X is also the second largest stock exchange in Africa as measured by market cap, with over 122 securities listed on the platform, including 23 top 40 stocks with a combined market cap of some 8.8 trillion rand. There is no cost, risk, or additional regulation for a secondary listing on A2X, and it provides an issuer's investors with the opportunity to save money. The team at A2X is proud to be partnering with Unlock the Stock. Just as this platform unlocks value through insight and key analysis, A2X unlocks value for the stocks listed on its platform and helps drive the market forward. This platform would not be possible without our technology partner, Lumi Global. Their website is lumiglobal.com, and you can visit it to find out more about their various AGM and investor presentation solutions. Our hosts today will be the Finance Ghost and Mark Tobin from Coffee Microcaps, and they will be facilitating the Q&A after the presentation. Before we commence, a few housekeeping rules. TWK will provide an overview of the group through a presentation. Thereafter, you can post questions by typing them into the chat function at the bottom of your screen. The event is being recorded for the Unlock the Stock YouTube channel, which we urge you to subscribe to. We would like to welcome Andre Myburgh and Eddie Fivers, CEO and CFO of TWK Investments. I now hand you over to Andre and Eddie. Please, can you share your screen?
Thank you very much, Marlies, and welcome to everybody. It's a great privilege for me to present to TWK. For you guys who don't really know TWK at this stage, I just want to give a little bit of a background of TWK. If we look at TWK at a glance, then first of all, TWK Investment is listed on the Cape Town Stock Exchange, and then we also have a secondary listing on A2X. TWK is a diversified agricultural group of companies, and I think it's very important from the beginning to say that the diversified agricultural companies is very important for us, because I think most of the investors is always a little bit scared of agriculture, because one year it's up and next year it's down because of the commodity prices going up and down. But what we're trying to build in TWK is a business that has diversified income streams, and also we're looking at different commodities. So that helps us to be sustainable and every year operating and have good profits. So if you're looking at this year, first 6 months, once again, 3 of our segments didn't perform that well, but the other performed quite well, and that is why we still have a very good 6 months. So our following segments is timber, retail and mechanization, financial services, grain, and the motor industry. That is the segments we operate in. If I can start with timber, we provide, and I must say timber is our core business, first of all, and even in timber, we have diversified income streams with different markets to make sure that every year, or whatever happens with one of the income streams, the other ones also still producing and performing well. We provide multiple processed and unprocessed timber products while cultivating about 37,400 hectares of forestry plantations in South Africa as well as in Eswatini. The timber segment assets and activities includes forestry plantations, wood chip export facility in Richards Bay, lumber and mining timber sawmills, timber and vegetable seedling nurseries, bedrock mining timber, timber marketing, treated timber plant, that is where we treat our poles, charcoal production, untreated timber products, and also logistics. TWK owns and operates a world-class wood chip production and export facility in Richards Bay, with capacity of production and exporting about 900,000 tons of wood chips per annum. In our nursery, we have Sunshine Seedling, producing over 50 million vegetable seedlings every year, 10 million forestry clones, 7 million forestry seedlings, and just over 4 million essential oil seedlings as well. Totally, the timber sales volumes that we did last year was 1.459 million tons that we did last year. It's very important for us, our conservation and environmental part of the business, especially in the timber side, is very important for us. So that's why all our plantation is FSC certified, and we also have for all our production units, we have the necessary certification that we also have our ISO and SANZA certification for all our production facilities as well. If we're looking at retail and mechanization, the retail mechanization segment comprises of 32 retail outlets, 5 Constantia fertilizer depots situated in KZN, Mpumalanga, Northwest, Eastern Cape, as well as in Eswatini. Then we also have 5 Constantia fertilizer blending facilities. That is where we blend our fertilizer or make our fertilizer. We only blend it. That is in KZN, Mpumalanga, and Western Cape. The average fertilizer sales over the past 2 years was about 250,000 tons per annum, and that is around about 10% of the South African market that we supply. Mechanization sales, which includes tractors, construction vehicles, and also equipment, is done through our New Holland agencies that is situated in KZN as well as in Mpumalanga. On our financial services side, the financial services segment provides unique finance and insurance solutions to the agri and related industries. And it consists of 2 main divisions, our insurance division and our credit division. Our insurance division is insurance brokerage. This is our short-term insurance brokerage, then crop insurance brokerage, agricultural insurance, plantation insurance, liability insurance, transit cover, medical aid and gap cover, life insurance, wills and testaments, funeral administration, fiduciary services, and also other specialized insurance products. Then our credit division, I must say, we only provide credit for what we're selling. So we have a seasonal credit facility, that's our production facility, month accounts, forestry loans, and also asset finance. Our production book was standing at 916.7 million at the end of February. We mostly finance the summer production area. So in February, it's on our highest side. Then it's going back down to August when the harvest starts coming in and farmers is paying back on the production loans they have. Last year, it was only 808 million where it was peaking. If you're looking at grain, our grain segment have 3 divisions, namely our grain silos, grain marketing, and grain industry. Our grain silos, we're responsible for the safe storage and drying of grain for our farmers. That's also we adhere to all the HACCP standards, and then we also have Suffolk registered silos. Then the grain marketing, we're responsible for on-selling the grain at the best possible marketing price, and we also use Suffolk to help the farmers to make sure that they're locking in prices for their maize as well, or soybeans, or whatever they're doing. The grain industries, we're manufacturing of animal feeds and supply into retail, wholesale, and farmer level, and manufacturing of own branded maize meal products which are supplied to retail outlets. If we're looking at motors, our vehicle dealership and business units are based in Piet Retief, Ermelo, and Standerton, and that consists of mostly 2 Toyota dealerships, 2 Isuzu dealerships, and also 2 Avala and GWM dealerships, and 1 Hino dealership. Just a quick look at the major business risks that we have listed. First of all, political and economic risk, then availability and allocation of capital, third-party infrastructure, information technology, competition, the Reputational risk, weather and climate, then volatility on commodity prices, because that is always a volatile thing, the commodity prices, then of course fires because of our plantations, and then also credit risk, and then you can also see what the mitigation factors we have there. Then I'm going to hand over to Mr. Fivers that we're going to take you through our financial for the first 6 months of the year.
Thank you, Andre. Ladies and gentlemen, also welcome from my side. I must admit it's almost feel out of my comfort zone this morning because it's the first time that we've presented TWK with numbers that's down from the previous period. However, we are confident about our business model, and we are also confident that the second half of the 2023 financial year will outperform the second half of the previous year. Just quickly recap the full year results of August 2022 before we dive into the half year results of 2023. The revenue of the full year last year was 9.9 billion. That was up by 17.79%. The EBITDA was at 673 million. That was up by 27%. The profit after tax was at 362.8 million. That was up by 41.73%. That was really driven by an increase of total volume timber sales. That was up by 88% in August 2022, especially an increase in the volumes of timber exports. That was up by 88% to 634,000 tons. The profits was also driven by record high fertilizer margins and sales through our retail segment. Basic earnings per share was at 8.63 rand. That was up by 45%. NAV per share at 52.55, up by 13%, and cash from operating activities before changes in working capital was at 535 million. That was up by 39%. Now, if we look at the half-year results, ended 28 February 23, revenue was up by 7.6% to 5.25 billion. EBITDA down by 13% to 372 million. Profit after tax down by 16.6% to 205.7 million. Our basic earnings per share down by 21% to 4.47 rand. Net asset value per share up by 8.8% to 54.68. Cash from operating activities before working capital down by 22% to 357 million. However, our cash management was very effective this 6 months, and we've managed to counter the negative impact of the working capital, or we've managed to counter the negative cash from operating activities through effective working capital management. Therefore, the total effect on our cash wasn't as severe. If we look at the key financial indicators for the 6 months, revenue increased by 7.6% to 5.2 billion. That was driven by especially increase in our timber exports to our clients, and also driven by grain commodity prices during the 6 months. Our EBITDA down by 13% to 372%, especially driven by margin pressure from the fertilizer business and also costs and the related inflations during the last 6 months. Profit after tax down by 16.6% to 205 million, and basic earnings per share 21%, like I mentioned earlier. What I want to highlight on this slide is the fact that we, during the last 6 months of 2022, the profits wasn't as high as the first 6 months. In other words, we outperformed, or normally we do better in the second half of the year. However, the first 6 months, we've outperformed the second half of the year. That was really driven again by the fertilizer margins and the good fertilizer business that we've done in the first 6 months of the previous financial year. So you can note in August, during the year of August 2021, we've done better this second half of the financial year. We expect this financial year to be on the same basis, that we will achieve better results during the second half of the year, especially due to increased export volumes to our markets. We look at total equity, year-on-year growth increased by 6.5% to over the 2 billion rand as of end of February. Also, NAV per share constant growth every year increased by 4.1% from August 22 to 54.68 rand. If we look into our segment analysis, we're going to look at the revenue and the EBITDA. This represent the total contribution as per percentage for every segment that we've had. The first portion is the full year of 2022, and the bigger circle is the half-year results of 2023. There we can see that in terms of revenue, the timber had a bigger contribution in terms of total revenue. It was at 22% full year to 28% half year. Fertilizer a bit down, so it was still good revenue from that segment, however, lower margins. And we've also experienced good growth from the other segments, although not all of them revenue increases, but especially in the financial services segment, we experience good EBITDA growth. If we look at the EBITDA then, especially a decrease in terms of our retail and mechanization segment, but that was countered by a substantial increase of EBITDA from our timber segment. Like I explained earlier, the EBITDA of our retail and mechanization segment was severely impacted by the decrease in margins from our fertilizer business, and we will discuss it a bit later. If we look then into detail, our timber segment, the revenue increased by 28.66% and the EBITDA increased by 21.62%. The growth especially came from the wood chips exports and also local timber sales. The exports was in total for the first 6 months 384,000 tons compared to 282,000 tons in the prior period, and that represents a 36.1% increase. Total sales volumes have also increased by 19.92% to 771,000 tons, and that was, like I said, driven by international and our local markets. The influencing factors for this segment is the demand for our wood chips from international customers. It currently remains robust, and we predict that it will remain at that levels going forward. The revenue was also supported by the weak rand, and for the coming 6 months, the revenue will also be supported by an increase in our dollar based prices to our international markets. Sales to the mining sector, however, was down from prior periods because of a closure of 2 shafts from some of the bedrock clients. Load shedding also impacted our business as well as our customers, and that also had a negative impact on the timber business. The peak timber business continued to perform very well, and we predict that that will remain same in the future. A very good asset that we acquired a while ago. Sunshine Seedlings also recently acquired Top Crop, and we expect some good returns from that acquisition. If we look at the retail and mechanization segment, revenue marginally increased by 0.32% and EBITDA decreased rapidly by 72.63%. Like I've mentioned a bit earlier, the segment came under severe pressure as a result of the Constantia fertilizer business and the performance of that business. The fertilizer sales volumes declined by 22% to 94,000 tons from the 121,000 tons the previous year. And that was due to a 48% decline in raw material prices, and farmers then hold back on buying fertilizer on the hope of further declines before they buy. There was also a worldwide oversupply of fertilizer, which impacted the segment. Mechanization sales, on the other hand, through the New Holland agencies, decreased by 6.94%. We've only sold 134 units compared to the 144 units in February 2022. Influencing factors, the global fertilizer prices set to decline further. However, we think it's almost at the lower levels, and that's driven by the producers in the Arab Gulf and the Baltic states. That's really influencing the prices, but we think that the prices is now on the lower end, and we will see some better movement in the next 6 months from the fertilizer sales. What impacted our mechanization sales, the decline of our units, was the availability of the higher kilowatt equipment tractors, especially the New Holland tractors, which we supply, and our agency, because of constant constraints from the global logistical change. However, we see some improvement, especially from the international side. However, still locally, it's still a problem to get the equipment from the harbor to our clients. Hopefully, that will improve soon. If we look into the financial services side, revenue up by 27% and EBITDA up by 35%. The insurance division performs very well. Reported a 9.97% growth in short-term insurance premiums, and that resulted in a 6.19% increase in commission income. Also a 22% increase in total crop insurance premiums, and that translated to a 17.27% increase in commission income, with a 1.48% increase in crop hectares insured. Also, very good growth from our medical insurance portfolio, and that resulted in a 14.94% increase in members, and also good revenue from the medical insurance. Life insurance business grew commission income by 26% for the period under review, and we constantly focus also on that part of our business. The credit division, which form part of the financial services segment, reported net interest growth of 2.39%, and that was driven by a grew of 13.3% of the production facility book to 916 million. However, the bridging facilities decreased by 60%. That's just to prove that the health of our book is in a good state. It, however, decreased the interest that we've earned. But like I said, we are very satisfied about the health of our credit book. If we look into the grain segment, revenue increased by 57%. That was mainly due to robust performance in the grain marketing division. That's also where our focus will be for the foreseeable future, is to see how we can improve in our marketing division segment, because we realize that that will be where the growth for this specific segment will be. There was then EBITDA decreased by 48%. EBITDA margins also down by 1.68%. That was really driven by high commodity prices, and that unfortunately had a negative impact on the grain segment. We also think that the grain segment will perform better the next 6 months because of the recent decrease in the grain prices. Like I said, the grain marketing business, solid set of results. Excuse me. And this really is a result of marketing in a wider offset area. And we've also appointed a new grain trader, and we are very positive and convinced that we will benefit further from that. The grain mills, our own grain mills, supplying white maize meal to food retailers, was negatively impacted by high prices and also the consumer inflation pressure that had a negative impact. But we think that will be better for the next 6 months. Arrow Feeds based in Eswatini reported an increase of 23% in revenue, despite a 2.49% decrease in volumes. Our last segment, the motors segment, revenue from continued operations decreased by 36%. That was mainly due by 10.9% increase in new vehicle sales, and also a 15.8% decrease in used vehicle sales. At the end of Feb 2023, the majority of our filling stations have been sold, with only the Piet Retief total filling station, and we've currently classified that as held for sale because it's also in the market. EBITDA from continued operation decreased by 70%, and EBITDA margin weakened to 1.8%. Influencing factors for this segment is the severe stock shortages in major vehicle brands, especially Toyota, due to manufacturing plant being closed due to the flooding in KZN, and also challenging marketing conditions such as high fuel prices, interest rate hikes, and other inflationary pressure to our customers. And again, over to Andre for outlook and strategy.
Thank you, Eddie. I think this is always the important part for investors to look what's the outlook, to know how we see the outlook. And I think, first of all, we must ask the question is, why invest in TWK? Or either if you haven't invested yet, I must ask, why haven't you invested in TWK also in 2019 already? Because if you invested in TWK in August 2019, you had growth of almost over 100% to August 2022, when we're standing on 51.5 rands. So I think we have good growth in our share price. In February, it was at 49 rands, a little bit down from where it was in August. but I think today it's back at 53, 54, around about there. So I think we've got good returns for our shareholders if you have invested in TWK a few years back. We also, if you're looking at our dividends, we grew our dividends every year, year on year. It's only at 2020 when it was the COVID year, when we were very conservative, and although we paid dividend, we didn't grow the dividend that year. And also you can see it if you're looking at the dividend cover, you see it was at the 6.2 times. So that was also a year that we were a little bit conservative. But last year we had very good growth in our dividend, although the dividend cover still sits last year at 5.8. So I think we also a little bit conservative with the dividend, but we also make sure that we have enough money to grow the business, to have money for the growth that we also want to finance. Then if we have the outlook, I think, and Mr. Five already mentioned it, TWK expecting an improved second half of the year from our segments. And he already explained to you why we think we can have we can outperform last year as well. And that is once again because we have the different income streams, and we also not only invested in one commodity as an agriculture company, but we are over different commodities, and also in the value chain we only invested in one part of the value chain, but we try to be part of the whole chain. Load shedding does not have a major impact on our operations, as we generate sufficient energy for our generations, backup batteries and solar installations. Although we don't have a problem, it still comes with a cost, and we can also see that in our costs, that operating cost is much higher, and this is also part of it, but at least we can go on with our business as usual, although it is costing us a little bit more. The timber business prospects are good, and the agricultural outlook, despite challenging macroeconomic conditions, remain positive. That's how we see it. And then, of course, like Eli also mentioned, increased wood chip export volumes supported by a weak rand will drive profit growth in the second half of the year. And with that, also, we believe that there's going to be an increase in our prices as well. That is going to be a huge benefit for us as well. Then also improved fertilizer prices that will benefit the retail mechanization business. And then improved fertilizer prices is actually the cost prices, because we are behind the curve, and if you sit with any product, it's costing you have to sell it, and then you have to sell it at a loss, and everything that's coming in, if it's going down the price, but we think that the prices is near the bottom at this stage, and actually it can have a little bit of a problem when it is planting season, because all the fertilizer businesses are sitting with low levels of stock, and it can put a little bit of pressure on the prices if there's not enough stock when come plant time to plant, and all the farmers they're still waiting to buy as late as possible, because the fertilizer prices is coming down almost every week. Then the financial service business continue to grow its footprint. We optimize existing offerings by looking at innovative products and services, and then we continue to evaluate strategic opportunities. We're looking at always at expansion, then through acquisitions, mergers, and strategic alliances, to make sure that we still keep growing the business and do it in a sustainable manner. Then just quickly on the strategy, I think that's important that strategy is first of all built around our stakeholders, and that's where we want to be the supplier of choice and the market of choice, and by that achieving sustainable growth with our customers and our communities. The second point, how our strategy is built on our financial performance, where we want to be the investment of choice, and that we do through the creation of shared value our entrepreneurial spirit, commercial expertise, focused innovation, technology enablement, and ongoing process optimization. And through that, we can have a strong deliver sustainable growth. Then on the third point where we built our strategy on is on process excellence. So we manage and optimize process excellence and also effectiveness. And then lastly, it's built on our people and transformation to ensure that talented people and intelligent technology are the building blocks for our future success. And that's from our side. Thank you very much.
Thank you, Andre and Eddie. I'll now hand you over to the finance ghost and Mark Tobin. As a reminder, please post your questions into the chat function at the bottom of your screen.
Andre and Eddie, thank you so much for your time today. That was very interesting. And welcome to everyone. As you know by now, hopefully on Unlock the Stock, if you have questions, which I'm hoping you do, you can either DM them to me or to Mark Tobin, and we'll try and make sure that we get through all of them over the course of the session. So I'm going to go first. And Eddie, this is possibly one for you. You know, I think that was such a great chart around the sort of compound annual growth rate in the dividend. You know, it's always a good sign when a company can achieve that sort of growth in a dividend, because it means the cash is well managed. And the other thing that stood out for me in this result is, as much as profitability is under pressure year on year, it was actually a pretty good outcome in terms of the NAV, in terms of cash management, et cetera, et cetera. So I think just some comments around, you know, how do you guys achieve this in working capital? Is it just incremental improvements every year in the way the business manages cash? You know, are you getting to a point where those improvements are starting to run out? How much more can you squeeze out of this thing? Because it's a very impressive dividend story.
Yeah, thanks. I think it's really based on a couple of things. First of all, especially since COVID strike, we've critically evaluated all our businesses, and we've started to realize that there's some of the businesses that's not core businesses. They are not performing well, and we've decided that we're going to disinvest in them. So from that, we've unlocked cash from that basis, and also most of those businesses were not performing well. So we've basically stopped the blood, and that also, yeah, obviously improved our cash performance. And then secondly, we want to make sure, and we've used our technology to do it, to make sure that we do have the right inventory at the right time for our customers. So it's really a balance. If you don't have it on time, you're going to lose that sale forever. But it's really with intelligence that we manage that, make sure inventory is on time, and the cycle, working capital cycle, is then optimized in terms of that. Also, good management in terms of our debtor book. As I mentioned earlier in the presentation, that our bridging facilities were at 60 million last year this time, and we've managed to get that down substantially, and that's also obviously then a positive cash flow. So really based on that, we've managed to increase or keep our cash resources positive, and that really helped. And I think with that as well, we do have a very effective syndication loan agreement with Standard Bank and Absa and FNB. They support us, and with that very effective structure that we have, also support our cash cycles. I think that's really the most critical things, how we manage to do that.
Eddie, I've got one for the audience, probably best for you. It was around the corporate segment, where there was a massive jump in the results from 88 million this period from 16 million in the previous period. Can you maybe just talk to that a bit? Is that just seasonality, or just coming from one particular thing from a particular segment, or why was there such a kind of a step change there?
Sorry, I didn't really get that question from which specific?
It says the corporate segment made a
the
massive
corporate segment.
results
Okay, sorry.
from up to 88 from 16 in the prior period.
Okay, 100% got you. Thanks for clearing that. So our roof space business, actually, I'm glad that you asked it because we didn't mention it. Our roof space business was held for sale at the end of the financial year. And we've managed to successfully sell that business with a substantial profit. And the profit from the sale of that business is included in that segment. So that's really the reason behind that.
Very great, thanks.
I'd like to dig in a little bit to the sort of financial services side of the business. So a couple of questions, and I think just to clarify the business model a bit, and for attendees who just want to understand how you make money in that space. So there's the insurance piece, which I assume is very much a commissions-based business, that you're not necessarily carrying the insurance risk on the balance sheet. So I just want to confirm that. And then on the lending business, just some commentary around how that's actually funded, what the exposure is to moves in the interest rates, for example. Just a little bit more about that financial services side of the business, because I think it's quite interesting.
Okay, thanks. Thanks for the question. I think it's a very important question. So first of all, the insurance business, it's really only insurance brokerage business. So really only the admin that we do. So we don't carry any insurance risk on our balance sheet. It is a division that we focused on the last couple of years, and we saw some excellent results from the investments that we've done in that business. And that it's also a strategic focus for us going forward, because we do have the technology, we do have the expertise, we do have the footprint, we do have the customers. So it just makes sense to grow that business. So it will be a focus. In terms of our credit division, so what we basically do, the business model is really an on-lending model where we borrow funds from the banks. And that's where especially the syndication facility from Standard Bank, FNB and ABSA came into play. Borrow funds from them and on-lend to our farmers for them to be able to produce their crops. So the margins from the interest on itself is really thin, but it's really based on our total business model, whereby with these funds that we on-lend to the farmers, they are only able to buy from our network of 32 branches, especially across KZN and Mpumalanga. And that's where really the business lie and where we make the margins. So it's really an interlinked business. We need the financial services or the credit division to support the other. However, we critically evaluate all our customers where we on-lend the money to make sure that we don't carry too high credit risk. So the funds are, there's good securities for that funds or the loans that we give to our farmers. And that's also proven, especially in the last years, that we didn't write off substantial bad debts, or it wasn't even necessary to provide substantial provisions according to IFRS 9. So our debtor book really healthy. Again, like I've mentioned earlier, the bridging facilities come down substantially, and that's really just a proof of it. In the past, we did focus to increase also term loans for our customers, but that's low margins and also not healthy for our balance sheet. So we basically stop with that. We will only do it when it's really necessary to retain a good customer in terms of the production side. We are currently busy to look into better structures, how we can assist our customers with term loans on a basis that it will not increase the risk from a TWK perspective or have a negative effect on our balance sheet. I think that's really in a nutshell the financial services business.
Andre, maybe if we can just touch on the woodchip business, which was, one of the standout divisions in this result. How much, and you said demand looks robust from what you can see coming down the pipeline. I mean, how easily can you satisfy more demand? Because it was a big step up if we, think of wood chips. If you go back one step in the process, the raw material takes a few years to grow. So I'm just wondering, where is the potential bottleneck, or how far away are you from, that raw material bottleneck?
Yeah, I don't think the raw material is a bottleneck. At this stage, if you're looking at, I've also mentioned it in the presentation, that our facility have a capacity of 900,000 tons. So that's more or less where the bottleneck is, and that's what we, been able to export. Also, you must take in consideration Mondi and Sappi have also put another capacities, increase their capacity at their mills. So definitely, and Bison as well. So the South African timber, we're probably going to be exporting less, and more of that is going to be utilized in South Africa itself. But around about that 900,000 tons, that's more or less where we're going to input the raw material. And that's why we also invested in peat and so on, to make sure that we have enough round timber to supply as well.
Okay, great.
Got a couple of questions here in my DMs that center on, I suppose, South African infrastructure. It's inevitable, right? It's the dynamic duo / two swear words of Eskom and Transnet. So the first question is just around, the cost of load shedding, and just any more comments on that. And then what is the overall effect of Transnet and Eskom on your operations, and what can you do to mitigate your reliance, I suppose, on the government giving us these services? I guess Eskom being easier to try and get around there than Transnet potentially.
Yeah, you've already answered the one, like I said also in the presentation, we are not only reliant on Eskom. We can operate without them, but with a certain cost. And if you're looking at that cost, what it's costing us to operate without Eskom, and the extra it put on us is around about, I think, 15 million.
For the first 6 months, yeah.
For the first 6 months. That is costing us, to operate with where we don't have Eskom power available. On the Transnet side, at least there's some positive signs. I must say we are, as an industry, for the exporting side of the wood chips, we are far down the line. Looking at the maintenance, that we take over the maintenance, because the maintenance is the important thing, and we need efficiencies, and you don't have efficiencies if you don't maintain the loading and the facility correctly. So we are far down the line, negotiating with them to take over at least the maintenance of that loading facilities in Richards Bay, TTP. On the Transnet rail side, at least I think in the next month or two, hopefully, we can also once again have some of our timber being transported by rail. It makes a huge difference in the cost of transport, of course, first of all. And then also in our plant in Richards Bay, we have to spend a lot of capital also to accommodate, suddenly there's all of those plants are built because the most efficient way is with Transnet, with rail. And now you have to accommodate a lot of trucks coming in. So we have to spend a lot of capital, first of all, on that. And then I think it cost us about $1 million a month more now because you have to handle timber twice, and put it here and then reload it. So it's definitely costing us. If rail can come back, first of all, it's going to be improving the cost to get it to Richards Bay. And then secondly, also the operating cost of the shipping facility itself will come down dramatically once again if we can get it from rail. But there's some good discussions that we have, and we're positive that in the next month or two we will have some of our product going down on rail again. If that answers your question more or less.
Maybe if I can just ask one quick follow-up before I give it back to Mark. So just in terms of renewable energy opportunities, I mean, given the sector you operate in, there's a lot of bio waste, surely. I mean, I'm no engineer in this space, but I think people might be interested to know what are the renewable energy opportunities available to you, to get away from generators, get away from Eskom going forward. Yeah,
so most of our plants we already have solar, but unfortunately, if you have solar, you have to have a base load, and that's what we are looking at. And if you're looking at bioenergy, we definitely are investigating that. It's all about once again your transport, getting that material to that bioenergy plant of yours. So we definitely looking at that and probably going to go ahead in that process as well. But at this stage, I think still, if you're looking at the renewable energy, then solar is for us the cheapest, but then you need the base load, and that's where the generator normally comes in. And we are still investing in that also more and more, but we're also looking at opportunities to looking at the bioenergy plant as well.
Can I just touch on the fertilizer business for a second? I can understand farmers holding back, because prices are coming down. But I mean, surely they can't hold back forever. I mean, plantings are going to happen. They're going to utilize fertilizer as part of their, everyday process. But does that then, the sales will come through, albeit at a lower price point, but does that, as we go further through the cycle, kind of come in as a quasi benefit to TWK, as in lower input costs for the farmers, improves their profitability. So then you kind of pick it up a bit later on in terms of the retail division, the mechanization division, the mower division, and the financial services division, because more profit at the farm gate translates back into other divisions. Let's go look out 6-12 months from now.
Yeah, definitely. I think you answered your own question, but definitely it's going, because, and that's why it's important for us to be in the whole value chain. If you only one part of the value chain, you lose out on some of the benefits. If it's improving on the one side, it can only impact you negative or positive. But if you're in the whole value chain, you can have where it's impacting you negatively, it can impact you down the value chain positively. So that's also why it's important for us to have different income streams and be part of the whole value chain, because that's how it works, and that's how we've been able to have sustainable growth in our business and performing year on year, not like normal agricultural cycles, 1 year up and next year down. And that's the reason why.
Question from my side, just on the motoring section, the motoring segment. So we've seen some very good results out of some of the listed players like CMH, for example. I know you've had a struggle with this, and I'm guessing a lot of it is the reliance on Toyota in your business versus a CMH, which is nowhere near as reliant on one brand. I just wanted to confirm that, because there's obviously quite a disconnect there between the performance in your segment and the Motus and CMHs of this world.
Yeah, definitely. Toyota is actually is the biggest. That's our main part of the motor division, and because we are on, I don't say in a rural area, but we are in small towns, and now that there is not enough volumes, then they allocate it also because it's about allocation. We don't get the first of all, you know, it depends on where you are and how much you have sold in the previous years. So we are not the biggest, and so now we're also getting not as much as some of the bigger dealerships are getting volumes of specific cars. So that's definitely where it's hurting us, is that we're not getting the volumes that some of the other dealerships are getting.
Eddie, maybe just one more on the financial services division. Is there scope for, you know, more products to be added in there? I'm thinking, you know, something like an RA product where you also have a partnership distribution model, but it's just, you know, one other offering that can come in there that, you know, could be a potential, you know, easy sell there, because, you know, they've, you know, people like kind of simplicity. Okay, you know, kind of everything is with Hall Mutual, or I've got everything with Alan Gray kind of thing. And, you know, when you're such an integral part of their kind of business and the communities there, you know, it's kind of a trusted sales relationship, if I can say that.
Yeah, I think you're 100% right. Our business in terms of financial services is really built on strong trust relationships over years from our customers. But to answer your question, we will always look at potential new businesses. As long as it is a strategic fit, it can add value to our customers, and if it can yield a positive risk or risk-adjusted return. Like I mentioned earlier in the discussion, is the financial services, especially the insurance division, is a strategic focus. We are currently looking to invest in more insurance books. There's a couple of them that we are currently investigating, and hopefully we can conclude on them in the near future. Quite interesting that you think RA is a potential. I don't think we've thought of that in the past. It's not really one of our key expertise, but if it's a strategic fit, if we can get the right partners, because the right partners is always important for us, because corporate governance is a critical component on how we build our business. So partners will be important for us if they can also be aligned with our governance structures. Then we will definitely look into everything that can fit into that business and add value.
Okay, great. Gentlemen, I think we'll hand back to Marilise, because we're just 1 minute away from the hour, and I want to be kind of respectful of everybody's time. And Marilise, if you want to just wrap up there for us, please.
Thank you, Mark. Thank you to everyone who participated in Unlock the Stock today, and a special thank you to Andre and Eddie for making the time to support this investor platform. A reminder that if you'd like to be added to the TWK Investments contact database, please email inga@chris.co.za. We hope you have enjoyed this event, and if you would like to listen to it again, it will be on the Unlock the Stock YouTube channel soon. Please join us for the next session of Unlock the Stock on Thursday, 25th of May, to hear from Calgary M3. Please look out for the invitation. Goodbye.